Well, there's been a lot of talk lately about silver ripping higher again, and whether this move is the start of something huge or just one of those loud emotional spikes that looks unstoppable right up until it isn't. So, in this video, we're going to separate fact from fiction, and you are going to walk away feeling a lot smarter and a lot more confident about what you're watching. Today is Saturday, February 21st. You take gold, you divide by silver, and you get this one number that seems to tell you who's cheap. And lately, as silver outpaced gold, that ratio slid down into the low 60s neighborhood. But I want to challenge the implied conclusion right away. A falling ratio does not automatically mean buy everything. Ratios are like a thermometer. They tell you the temperature, they do not tell you what caused the fever, and they definitely don't tell you when it breaks. So yes, the ratio tightening can be a bullish sign for silver strength. It can also be a warning that silver is running hot and could snap back faster than gold if something changes. And this is where the next cliffhanger comes in. What could change fast enough to flip that ratio in a week? Hold that thought. Next up, the big league comparison. You've probably seen those lists that rank the biggest assets on the planet by market value. Metals, mega cap stocks, Bitcoin, the whole leaderboard. And silver has been hovering near the very top of that list, trading places with the giants depending on the day. And this is where a lot of people get fooled because they hear market cap ranking and they assume it's like the Olympics, clean, objective, final. It's not. It's more like a scoreboard at a stadium where half the fans are watching baseball, the other half are watching basketball, and somebody is trying to combine both scores into one number. Those asset leaderboards often mix categories: precious metals, public companies, cryptocurrencies, even big funds. So when someone says silver is number 2 or silver is number 3, the right response isn't wow. The right response is number 2 on which scoreboard, using which rules at which moment. Because the scoreboard can change for reasons that have nothing to do with silver itself. A stock can gap on earnings. A crypto can dump on a liquidation cascade. An index fund can swing as flows move. And suddenly, the rank changes, even if silver is flat. So rankings are interesting, but they're not a thesis. They're like the weather app on your phone. It's helpful. It's not a contract with the universe. Now, why am I bringing this up? Because the competitor narrative leans on the idea that silver belongs next to gold on that list, and that it's just a matter of a few bucks. That's a seductive idea, but it can push people into the wrong behavior, chasing price because they want the ranking to be true. So if you're using the leaderboard at all, use it the right way, not as a prediction, as a sentiment gauge. When silver is near the top, sentiment is hot. When sentiment is hot, volatility tends to rise. And when volatility rises, you need to be more careful, not less. Now, there's another layer to this that almost nobody says out loud. Market cap for a metal is basically price times estimated above ground stock value. That's already fuzzy because we don't have a perfect real-time ledger of every ounce and every holder. So you're dealing with an estimate built on an estimate. Again, useful, not sacred. Okay, now let's connect that back to the ratio, because this is where the logic often breaks. People will look at a ratio in the low 60s and say that means silver is undervalued. Maybe, but ratios can stay wrong for a long time. The ratio can compress because silver is exploding higher. It can also compress because gold is stalling while silver bounces. Those are not the same environment. And to figure out which one you're in, you have to look at what's happening underneath: rates, risk appetite, industrial data, and positioning. So here's a practical way to think about it. If the ratio is falling because silver is being pulled by industry and investment at the same time, that's a stronger form of compression. If the ratio is falling because gold is just taking a breather while silver is having a momentum burst, that's a weaker form of compression. Same ratio, different meaning. And that's why I don't want you to just memorize numbers. I want you to read the story. Now, one more quick point before we jump back into the geopolitical catalyst. On Friday, silver looked stronger than gold on the week, while gold had a choppier stretch, even as it held that big psychological level. That kind of divergence is exactly what creates confusion, because you can have people saying gold isn't even reacting that much to scary headlines. And they're right. Sometimes it doesn't. Markets can get desensitized. Sometimes fear gets priced in earlier, and the later headlines are just noise. And that's why the next move can come from a totally different direction than the one everyone is staring at. Which direction? The direction that surprises the most people. And right now, the surprise would be either a fast cooling of geopolitical risk, which drains some of the safe haven premium, or a sudden macro shift, an inflation print, a policy signal that forces traders to reprick the whole rate path. Either one can flip the metals tape in a day. So keep that in mind as we move into the next piece, because the military buildup is the catalyst everybody can see. The harder question is, what catalyst do you not see yet? Now, I'm not saying rankings are destiny. I'm saying rankings are a mirror. They reflect what the crowd is valuing right now. And when silver is hanging that high, it tells you something important. A lot of money is already taking it seriously. But don't let that make you lazy, because the fourth piece, the piece that can change everything, has nothing to do with charts and everything to do with headlines. Over the last few days, the US built up a major military presence around Iran, and multiple outlets describe it as an exceptionally large concentration compared with other recent deployments. And whenever that kind of risk shows up, you get the same human reaction. People start looking for assets that don't have an earnings call or a quarterly guidance update. They look for things that feel outside the system. That doesn't mean the metals must go up forever. It means the bid shows up when uncertainty gets louder. Now here's where we need to be precise, because this is where a lot of scripts get sloppy. Geopolitical risk can light the match, but it rarely provides the fuel for a multi-month trend. The fuel is usually monetary conditions, liquidity, and real demand. So if you want to understand whether silver above 80 is a moment or a movement, you have to zoom out and ask, what's the fuel? And that brings us to the forecasts everyone is repeating. One major bank recently put out a view that silver could average in the low 80s over the year, with the idea that there's a higher floor, but the ceiling is less clear because demand can be a double-edged sword. Another big shop has been cited in multiple market summaries as expecting something like the mid-80s to around 100 on average in the same window, tying it to the green transition narrative and strategic industrial use. Okay, but before we even touch the numbers, I want to show you how people accidentally talk themselves into certainty. They'll hear a forecast like low 80s average, and then they'll do this mental trick where they picture a straight line from here to there, like silver is just going to take the stairs. But markets don't take the stairs. Markets take the elevator, and the elevator has a broken button. It goes up fast, it drops fast, and it pauses on random floors while you stand there wondering if you're stuck. So, when you hear average, picture a balance point, not a path. And there's another subtle thing going on too. When a big institution publishes a forecast, that forecast becomes a story that traders trade. It becomes a self-fulfilling magnet for a while, and then it becomes the target that gets faded. You'll see it over and over. First the forecast drops, then everybody repeats it, then price moves toward it, then the market overshoots it, then everyone says the forecast was too low. Then the same people who were chasing it up start rushing to the exits. So I don't treat forecast like an answer. I treat them like a clue about what assumptions are in the air. So what are the assumptions in the air right now? One assumption is that the fear bid will keep showing up because geopolitics is not calming down overnight. Another assumption is that policy will eventually loosen again, even if it doesn't happen tomorrow. And another assumption is that the industrial pull for silver stays strong enough that every dip looks like a buying opportunity. Now, those assumptions might be right, but they're also where the risk lives. Because if any one of those assumptions flips, the market can go from floor to free fall in a hurry. Let me show you what I mean with a simple mental model. Imagine you're driving a car at night in the rain. Your windshield is covered in water. That's your uncertainty. You can still see the road, but only in flashes every time the wipers swipe. Forecasts are like those flashes. They're a moment of visibility. They are not a guarantee that the road stays straight after the next swipe. So, the smart move is not to cling to the flash. The smart move is to understand the terrain you're driving through. And the terrain in silver right now is defined by one thing. Volatility is not a side effect. It's the product. That's why I'm going to slow down and talk about the plumbing for a second, because this is the part that makes people feel whiplash. When you hear silver is above 80, you're hearing a spot reference that gets quoted everywhere. But most of the real price discovery is happening in futures, options, and derivatives, where people don't need to own a single ounce of metal to move the price. That doesn't mean it's fake. It means it's leveraged. And leverage is like a microphone. It amplifies everything. It amplifies fear. It amplifies excitement. It amplifies headlines. It amplifies liquidation. So, when you see a big green candle, don't just ask who bought. Ask who got forced to cover. Because a lot of these fast moves are not fresh conviction. They're pressure being released. Now here's the cliffhanger. If this rally is partly a pressure release, what happens when that pressure is gone? That's when price either finds real buyers or it drifts. And that's why the next few sessions matter more than the breakout moment itself. Holding is the hard part. Breaking is the easy part. Now I'm going to do the same thing script A does. Separate the claim from the logic, but with this silver narrative. The claim is silver is above 80, therefore it's going much higher. The logic has to be, why is it above 80 and what keeps it there? So let's test the common explanations one by one. Explanation 1, it's all geopolitics. Okay, geopolitics can push safe haven demand. We see that in the headlines. But geopolitics doesn't explain why silver specifically is outpacing gold on some days. Because if it were purely fear, gold should dominate and silver should follow quietly. So geopolitics is part of it, but it's not the whole engine. Explanation 2, it's all rate cuts. This one is tricky because the market trades expectations, not reality. If traders think cuts are coming later, metals can move before anything actually happens. But lately, inflation data has been sticky enough that the Fed has not been rushing to hand out easy money, so the rate cut story is not a straight line either. It's a tug of war. Explanation 3, it's all industrial demand. Industrial demand is real. Solar uses a lot of silver. But here's the nuance. Industrial demand can be strong and still be price sensitive. Factories don't buy because they love your chart. They buy because they have orders. So if the economy slows, that engine can sputter. That's why silver can act strong, then suddenly trade like a risk asset. And that brings us to explanation 4, the one that almost nobody wants to admit out loud. Positioning. When an asset has a huge year, it attracts trend followers. Those trend followers create crowded trades. Crowded trades don't unwind politely. They unwind violently. So, if you're looking at silver and thinking, this time is different, you might be right in the long run, but the short run can still punish you. Now, there's a reason I'm spending so much time on this. Because the most dangerous moment in any bull market is when price action convinces you that risk has been deleted. It hasn't. Risk just got more expensive. Okay, now that we've set the frame, we can go back to those forecasts and use them properly. Not as a promise, as a scenario. A scenario where silver spends a lot of time in an elevated range with spikes and pullbacks, and the average ends up higher than the last year's average. That's basically what those low 8s average and mid 80s to around 100 statements are implying. But if that's the scenario, the next question is what enforces the higher range? And now we're back at the floor concept. So let's talk about floors in a way that doesn't make you roll your eyes. A floor can come from 3 places. 1, production cost and supply constraints. 2, a steady buyer. 3, a policy framework that encourages investment and limits destructive price wars. Silver has some of the first. It has a messy version of the second. And the third is the wild card. That critical minerals price floor discussion is basically about the third. It's about creating conditions where private capital will build supply chains instead of refusing to invest because prices can get crushed. And even if silver isn't formally in that exact system, the concept is a signal. Governments are thinking about strategic materials differently than they used to. Now, if you've been in markets long enough, you know what happens when something becomes strategic. It gets politicized, it gets regulated, it gets stockpiled, it becomes a headline risk. That can be bullish, but it can also create new rules that nobody expects. So the floor story has upside, but it also has new rules risk. That's a double-edged sword, just like the bank report hinted, and they're useful not because forecasts are magic, but because they show what large institutions think is plausible. But here's the trap. People hear average, and they mentally translate it into steady climb. That is not how averages work. An average can hide a roller coaster. You can have a year where silver spends time in the 70s, rips to the 90s, spikes beyond that, then dumps back, and the average still lands right where the forecast said. That's why the word average is both comforting and dangerous. So instead of worshiping the number, we should ask the better question. What would create that higher floor? And this is where the conversation gets really interesting because it's not just investors talking about floors anymore. A senior US official recently described a price floor system being discussed with allies and partners for critical minerals, emphasizing that pricing is key to unlocking private investment. Now, let me be crystal clear. That does not mean there is a government set floor for silver next week. Silver is not automatically included just because you want it to be, but it does tell you the direction of travel. Policymakers are openly exploring ways to stabilize pricing and materials they view as strategic. And that matters because silver sits in a weird middle space. It's a monetary metal in people's minds, and it's a critical industrial input in the real world, which brings us to the part that rarely gets explained correctly. Why silver behaves like a wild animal. Gold is mostly about confidence, currency, and reserves. Silver is that plus factories. When industrial demand is strong, silver can act like a growth asset. When panic hits, it can act like a safe haven. When liquidity tightens, it can act like a risk asset. That's why it whipsaws. So, if you've been confused watching silver move faster than gold, then stall, then explode, you're not crazy. You're watching a metal with two engines. Now, to add fresh context that was not in the competitor breakdown, let's talk about what those industrial engines actually look like. Silver is deeply tied to solar manufacturing because of its conductivity and the way it's used in photovoltaic contacts. Some recent industry analysis put solar's annual silver use in the ballpark of 200 million ounces, roughly a meaningful chunk of the total global market. At the same time, broader industry reporting expects overall demand to stay firm even as some segments soften, and it points to ongoing deficits as a backdrop that keeps investment interest alive. This is the floor story in plain English. If the metal is needed for real things and supply doesn't effortlessly expand, then dips can get bought faster. But I don't want to oversell that because here's the skeptical alternative interpretation you also need to hear. High prices can fix high prices. If silver stays expensive, manufacturers don't just shrug. They redesign, they thrift, they switch materials where they can, they slow orders. And on the investment side, a big run can create a wall of profit taking that keeps capping rallies. So the floor is not a brick. It's more like a trampoline. It's there, but you still bounce. Now, let's circle back to that geopolitical spark because the weekend timing is what has everyone on edge. When you hear largest buildup since the early 2000s, your brain immediately goes to worst-case scenarios. And markets do that too. They price fear quickly. But here's the twist. The fear bid can fade just as quickly if diplomacy headlines hit or if the situation cools without action. So, if you're watching metals into next week, don't just watch the price. Watch the tone of the news cycle. When the news cycle cools, you find out how much of the move was real demand and how much was get me something safe right now. Now, let's talk about the big picture gold argument that keeps getting used to justify silver targets. You've probably heard some version of this. Gold has held up better than broad stocks across many long stretches. And if gold has a long runway, silver goes along for the ride, sometimes with leverage. That can be true, but it's not automatic. Gold has a structural buyer that silver doesn't have in the same way: central banks. And the latest demand trend reporting shows central banks still bought large amounts of gold through last year, including a strong finish in the fourth quarter. That matters because it's not a retail narrative. It's a balance sheet decision. Silver doesn't get that same steady official bid. Silver gets more on and off behavior. So if you're basing your entire silver thesis on gold goes up, therefore silver goes up, you're missing the second engine again, the industrial side, and you're also missing the volatility difference. Now, let's address the price floor the way everyday investors actually talk about it. Not a policy floor, a trading floor. People keep debating whether silver can drop into the mid-50s again, or whether the last scary flush into the mid-60s was the real line in the sand. Here's my take, and I'm going to keep it honest. The exact number matters less than the conditions. If we get a genuine risk-off shock, like a fast equity drawdown, forced selling, margin calls, silver can absolutely fall harder than you want, even if the long-term thesis is fine. But if the backdrop is steady, rates are stable, inflation is sticky, industrial demand is decent, then big dips tend to get absorbed. So instead of asking, is the floor 50-some or 60-some, ask what would have to happen to force sellers to dump physical or futures exposure at any price. That's the real floor question. Now, I want to pull in one more piece of fresh context that helps explain why this year has felt so abnormal. The Fed has been cautious, and recent coverage of inflation data suggests policymakers are still looking for clear progress before easing aggressively. That uncertainty keeps real rates and the dollar narrative in play, which matters for metals. When rates feel like they could stay higher for longer, gold can stall. When traders start pricing easier policy later, gold can pop. And silver, because it's more volatile, often overreacts in both directions. So if you're trying to trade every wiggle, good luck. But if you're trying to understand the trend, watch the macro rhythm, inflation prints, labor data, and what the Fed is signaling. Now, let's talk about momentum, because the competitor script leaned on a winning months streak idea. Silver has had an unusual run, where month after month has tended to finish stronger than it started. Depending on the exact start and end points you use, it's been a long streak, and that kind of consistency is rare for something this volatile. But here's the thing. Streaks are great for headlines and terrible for risk management. A streak is like flipping coins and getting a bunch of heads. It tells you what happened. It doesn't protect you from tails. So if you're up big in this move, don't let the streak hypnotize you. Protect your plan. And if you're not in yet, and you feel that fear of missing out creeping in, remember the market will almost always give you another chance to buy. It just might not be in the exact place your emotions want. Now, let's talk about the historic reference point people keep throwing around. Back in the early 80s, silver had a peak that, when you adjust for inflation, lands somewhere around 150 an ounce. That number gets used as a magnet, like it has to come back. It doesn't have to. Markets don't owe you symmetry, but it is a useful way to think about one thing. When people say silver is already at an all-time high, you have to ask, in what dollars? That's why inflation-adjusted comparisons get attention. Now, here's the cliffhanger to end all cliffers. Even if silver eventually reaches that inflation-adjusted neighborhood, the path there will probably be ugly. It will be gaps up. It will be sell-offs that feel like the bull market is over. It will be days where you're sure you were wrong. And that's why the only way to survive it is to understand what you own and why you own it. So let me give you a simple framework you can actually use. First bucket, the fear bid. If headlines around conflict escalate, metals can surge. If headlines cool, that bid can fade. Second bucket, the policy bid. If the market starts pricing easier money later, or if the dollar weakens, metals tend to benefit. Third bucket, the industry bid. If industrial demand stays sticky, solar, electrification, supply chain security, silver has a fundamental tailwind. And fourth bucket, the positioning bid. If too many people get on the same side of the boat, the market tips them out. That's where the violent drops come from. So here are two questions I want you to answer in the comments. 1. What do you think matters more for silver from here, geopolitics or the next shift in interest rate expectations? 2. Do you believe silver's two engines make it a better long-term hold than a pure safe haven? Or does that just make it harder to manage? And if you're successful, share your success story in the comments so others can stay motivated. Now, before we wrap, I want to address something that shows up every single time silver moves like this. Promotions explode, giveaways pop up. Everyone wants your attention. There's nothing wrong with a promotion, but don't confuse marketing noise with market signal. The market doesn't care about a sweepstakes. The market cares about supply, demand, liquidity, and fear. So here's what I'm watching into the new week. I'm watching whether silver can hold above that big round number after the weekend because holding is harder than breaking. I'm watching whether gold can stay comfortably above 5,000 without immediately fading because gold is the anchor. I'm watching the news flow around the Middle East because that can jolt prices in either direction fast. And I'm watching the broader risk mood, stocks, credit spreads, volatility, because if risk cracks, silver can get dragged down even while its long-term thesis stays intact. And if you're new here, don't just watch price, watch behavior. Behavior tells you exactly when the crowd flips hard. If you want more updates like this, subscribe because I'll keep separating the excitement from the evidence. All right, that's it for today. And just a quick note before you go, everything you heard here is for education and entertainment. Think of it like a market study session, not personal financial advice. Do your own research.